All right, and we are live. Happy Thursday. Welcome to another Lunch and Learn with Purse Strings. My name is Maggie Nielsen, and I'm partner here at Purse Strings, and we're all about providing tips, tricks, pieces of advice on how to be financially fearless. And then if you are ready to plan for retirement, maybe get an inheritance, you're going through a divorce, you're buying a house, whatever it may be, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Pam Friedman is one of them. And so we're excited to have her on today and talk about some interesting stories about investing and divorce and really understanding the market. So before we dive into all of that, Pam, could you give us a little intro of who you are and what you do?
Yeah, hi everybody. Thanks for being here. My name is Pam Friedman, and I am a managing director and principal at Robertson Stephens. You can find us at rscapital.com. I've been in financial services for over 35 years. I've been working with directly with clients for about almost 15 years now, directly with individual clients. I was doing corporate work before that, raising money for big companies, and I taught at the University of Texas in Austin. Go Longhorns! You can still do that in here somewhere. Uh, but I'm here in Austin, Texas, but I have clients around the country for investment management. Many of my clients came to me because initially they were getting divorced. And so I walked them through with them. I was their thinking partner in divorce. And we got through the divorce and they became investment management clients. So I managed just over 100 million out of my office here in Austin, Texas.
Awesome. Well, we're so excited to have you on today and have you share your expertise. Anyone who is tuning in live, please feel free to throw any questions in the chat. Always happy to take care of those as well. And I'd just like to highlight Pam, she has her CFP, which is a certified financial professional, but she also has her CDFA, which is certified divorce financial analyst. So that's why a lot of people, do work with Pam for divorce. She has these two great designations that really help her and help her clients really understand the whole process and all these different things going on. But to kind of dive in here, how do you help clients who inherit investment accounts?
So oftentimes people find an advisor when there's a transition, whether it's they've become a widow and now they're suddenly in charge of money. So they inherit those assets. They might be the kids who inherit the assets and already a client of mine, and then they go ahead and inherit assets. So we'll look at it almost like it's a new client. We'll say, okay, now we're going to revise your financial plan for these new resources that you have. But more importantly, we'll look very closely at what has been inherited. Recently, I had an existing client who inherited $1 million account, but it was a single stock. And that stock was in the automobile space. And I told her, this is before we had the UAW strike, but I told her about diversifying. The benefits of combining two assets actually reduces the risk of the assets individually. So it's not the weighted average of those two assets. It's actually a little bit less because of what's called a correlation coefficient. It reduces the risk, but gives you that better return. And so we talked about diversifying, have many different types of assets to get the best return for the least amount of risk. And so since what happens when you inherit assets, those assets generally, not always, do what's called step up in basis, which means the tax cost is a lot less than it would have been if her dad had sold these assets before he passed. So I said, there's not going to be a big tax cost. Let's go ahead and get these, diversified quickly so that they can grow for your future without the kind of single stock risk that you can experience. And this was about 6 months ago. I had no idea that the UAW was going to strike. I don't keep up with individual industries all the time. Some I know better than others. And sure enough, we've had this UAW strike. And since that time, if you compare it to, it's a large company, so large capitalization stocks have fallen about 2%, where this particular stock has fallen more like 20%. So it subjected her to quite a lot of risk for the memory. Her dad had always had the stock. It did well for him. And I couldn't seem to convince her that having a single stock was a lot of risk. It turned out to be a lot of risk. And now we're back talking about diversification.
Yeah. I mean, first of all, how often do you see someone who just has a single stock? I mean, that seems rare.
It was $1 million. It wasn't just an insignificant
Yeah.
amount. And her dad probably should have been diversified, but we could have a different conversation about that. So you deal with the cards that you're dealt as an advisor, and we're here to give advice, but we can't tell you what to do, or is it you have to do this. You always have options, and she took the option of just keeping it and not having it managed, but now kind of regrets that decision. I mean, that happens more often that I'll have clients sort of regret decisions that they've made. I had a client in 2020 who just couldn't take the risk, just really was very impacted by the pandemic and felt like things were different this time. And of course, they weren't different. So he went to cash. He sold his investments, incurred a large tax cost in order to do that. This is a real story. Some advisors will tell the story and not know someone, but I mean, this just really happened to one of my clients. And it's someone who should have known better, who was in the financial services industry, not in my side of the business, but raising money for companies. And I tried to talk him out of it. I said, this too shall pass. Investments recover. We're in it for the long term. All the bumper stickers that we advisors advise clients on to stay invested. And sure enough, the market's recovered, but he didn't get to experience that because he was still out of the market. It's easier to say, I just want out, it's going to be bad the next few weeks, or it's going to be horrible. That's the easy part. The hard part that you don't see is that people don't get back in. So all these Notre Dameses, Michael Burry being one from The Big Short, coming out in January and saying, I'm going to short the market, and everyone follows on and wants to sell. And what did the market do? It went up. He was wrong. And so he missed that turn in the market. It's the reason to stay invested. You'll miss those turns back up. And so sometimes you have to take a bit of a ride and be confident that over the long term, our experience has been that your money will be greater than it is today. So staying patient pays off.
It's so interesting, like the different types of emotion I'm hearing come up in these different stories of, first of all, sometimes I hear a lot of emotion of when people get an inheritance of money and the way they want to spend it, they want to make sure it's aligned with almost how that family member would have wanted them to go about using it. Like they wouldn't want to pay off high interest debt because that's what they didn't think like their inheritance would be
used for. Yeah.
But then it's also the fact of, this high and low and timing the market. And so that's another reason why, you really want to trust a professional, that you want their advice and that it's, you believe it's sound quality advice. But I know after a while, a good professional can only say so much. And, it's really about the client taking the action.
Well, I'm all for emotions. You can't make decisions without your emotions, and expressing what your fears and concerns are to your financial advisor is an important part of our understanding what we need to address and how we need to address it, and show you charts and graphs and all those things if that's what you need to see. I think that's why there's this lack of confidence, especially from women, in the market. They don't want to let someone know that they don't know. By the way, a lot of more men don't want us to know as advisors what they don't know. And then they get caught up in paralysis analysis. There are so many offerings out there, products out there, so many choices, so many options. You're not sure you're talking to the right person. And even amongst CFPs, certified financial professionals, or longtime investment advisors, we're going to have different ways in which you can, spin how you're going to make money long-term in the market. And there's no one right way. There are lots of ways to deal with the fears and concerns that you have. I'm here to make the economic decision, but I need to know from you, what are the emotions around it? What are your fears and concerns? Because I can address those, and we can talk about all the statistics around staying invested and why that's important. That's just one of them. This particular client I was just talking about has promised me that he will talk to any client who wants to get out of the market because the market's down and thinks it's different this time. He thinks he lost hundreds of thousands of dollars by his own calculations. So he will not do that again. So
you live and you learn, right?
Sometimes you have to let the client kind of experience what they're going to experience. I'm here to teach you, but I can't make you make the economic decision over the emotional decision.
Right. Yeah. And so you just have to have these open and transparent conversations of, what you are feeling and, why do you think you're feeling this way? And, I know you can kind of help then kind of talk through those. And so I know there is the statistic that
Yeah.
Fidelity in 2021, their survey found that only 33% of women felt confident in their ability to make investment decisions. And only 42% felt confident in their ability to save for long term, including retirement, which is wild statistics. So
Yeah.
why do you think that is?
I think women think women want to do everything themselves, and including me. I'm guilty of this as well. Um, I want to figure it out. It's really the reason I became a CFP. I had some assets that I had earned during my time as an investment banker in New York and London, these high profile jobs. And I didn't trust anybody to invest my money. So I became a CFP, which is a little kind of extreme example of how women want to overanalyze things. But I really like helping other women understand what this market is about and why it's so important to invest. I mean, we are way behind in terms of investing. Something like 3.2 trillion more assets would be managed by advisors if women invested at the same rate as men. I think there's concerns about fees, about hidden fees, about understanding. Hire someone who is either fee only or fee based. Ask that question. How are your fees charged? What is the amount, not just the percentage? What are we really
Mm-hmm.
talking about here? And don't be afraid of it. The common fee is 1%. So on $1 million, that's $10,000. That sounds like a lot, but when you break it down to a monthly fee and what you could possibly earn, the benefits of having an advisor are estimated between 3 and 4%. And there's a Vanguard study you can go look up to prove that out, that having an advisor has that much more value to clients versus the 1% they're going to pay. It also gives you confidence, that not
Yeah.
only are you going to make money in the market, I can't promise people money in the market. I have no control over that, but I'm going to give you tax ideas. I'm going to give you ideas for asset protection. We want to protect your assets as much as we want to grow them. So do you have the right insurance in place? Do we have the right estate plan? Is this going to go smoothly if something happens to you? You're more likely to become disabled before the age of 65 than you are to die. Do we have protections in place so that your family can get to you and to your money? If
Yeah.
you're in the hospital with COVID and you're hooked up to a breathing machine, and we have to find out, how we're going to pay the mortgage. So having a power of attorney is very important. So any advisor, any certified financial planner, certified, um, any CFP or CDFA that's going to work with you is going to do more than just talk about their investments. In fact, I feel like we talk for clients who are used to the process and are used to the ups and downs of the market, we spend much more of our time talking about financial planning issues, tax issues, other issues that impact their finances that can really save you real money and you can see it. I have a good example. I know we were going to do stories. I have a good example of that.
Yeah.
I have an existing client. She was in her 60s at the time. She got married and moved in with her husband and had a house before. Her son was living in it, not paying her rent. So basically, it was still kind of her personal homestead residence. And she had not been out of that house for more than 8 or 9 months until she decided to sell it. So she sold it. Well, she didn't tell her tax advisor that this could be considered her homestead, and at least there need to be a discussion about it. It turns out we could qualify it as a homestead. We got the full homestead exemption for houses, and her taxes went from 25,000 to zero on that house. I mean, we as a CFP saved her 25,000. So I try to say, I will try to find ways to save you enough money to justify my fees for your investment portfolio.
Yeah. I mean, you definitely did in that situation.
Yeah.
But there is things that, a robo advisor or something can't really do for you. I mean, they can't be there in those trying times or make sure that your insurance policy is covering everything that it needs to, all your gaps are filled, different things like that. So there is, benefit with that fee. And I do agree, you got to break it down monthly. I was thinking one time about like lawn care or, house cleaning or something like that. I'm like, well, how much do you really spend at the end of the year? Because you only think about you spending it every 2 weeks or every month. It's like, well, at the end of the year, it's like $5,000 on lawn care. And that seems, outrageous. But when you pay it $200 at a time, it doesn't seem as much. You know what I mean?
Right. For many
And
clients, they're paying their advisor, I mean, depending on their asset level, because you usually pay based on your assets. They might be paying them less than their house cleaner or their lawn guy. Certainly
yeah,
those two combined. And this is important stuff. This is the money that you are going to need in your retirement, not just for living, but healthcare costs are going up. Medicare is covering less. These are all concerns that you should have about your future. It's just, we were talking about earlier, Maggie, it's just so hard to think long term when, 10 years, 15 years out, no less, 1 year out. Really difficult having an advisor to validate what you're thinking, or to challenge it and maybe present new opportunities to think about things differently. That's where advisors really can serve their clients.
definitely. And I think it's one of those things where it's, your retirement, you only really have one go at. Where it's like, if your house cleaner doesn't work out, you kind of have a sturdy house, you know how to take care of it, and you'll just get somebody else. It's not the end of the world. But your retirement is kind of one go. You want to get it right. I'm not willing to take a ton of like a risk of me figuring it out. I'd rather just hire someone and know that like I'm on track.
Well, and be open to the advice. I mean, I think in
Yep.
the case of my client who inherited the single company stock, she just wasn't ready to hear that advice, and it almost needed to prove out to herself. But now she's ended up with 20% down on $1 million, which can really be painful. Now, the strike will be over, and long term, it's not going to be down as much. But it does start you, in order to get back to even, she has to make more like 25, 28% return on that stock to get back to even. Just that's how math works. Because you're starting from a lower base, you've got to get a higher percentage return. So, like I said, I work with clients across the country. If you want to give me a call at Robertson Stephens, we're Robertson Stephens. We're here to help you. Pam.Friedman at rscapital.com. Glad to talk about your portfolio. The other is if someone's promising you 4% or 10% returns in any market, be a little skeptical. Like, how does that work? How is it that the company is able to offer that when the markets are all over the place? And how is it that risk is being shifted to you? Am I paying that in fees? Do I really understand why you're offering something that will protect my downside in the markets? Or economically, is that really proven out to be more valuable than just being in the market in a diversified way?
Right. Yeah. I always get wary when people can make 100% promise or guarantee, as I know most people who are fiduciary can't always do that. And so they don't always seem in line.
No one should be promising anything. If someone's promising you a 10% return, even an 8% return, whether they're saying the words guarantee or not, be suspicious. Talk to another advisor, compare what they have to say. You wouldn't hire the first lawn guy who showed up on your door. Maybe you would just test him out, but you're going to interview a few people to see who's going to be the right fit for you.
Right.
And I might not be the right fit for everybody, but I hope that by experience, I'm a better fit. So,
and so I know money market accounts and are kind of at historic heights right now. Can you explain real quick what a money market account is for those who don't know?
So money market accounts invest in a range of securities, usually very short term. And because of where the yield curve is, what the Fed, you hear on TV, the Federal Reserve has been raising rates. When they do that, they do it at the short end of the curve. So borrowing short term becomes more expensive than borrowing long term, which doesn't make logical sense. Normally we have what's called a yield curve where, if you want to borrow for longer, it's a higher rate of return. So we have the opposite right now. It's changing, but we have very high rates on the short end for very safe investments. There's a range of short-term investments, just like there's a range of long-term investments. One of the safer, I won't say the safest, but one of the safer is to stick to just a money market invested in government securities or treasury securities. Now, the return that you will get, that 5% that you may see advertised on a CD or other investment money market account at your bank, that's still taxable at the federal level. Depends on your state as to whether it's state taxable. But you need to be aware that that's just keeping up with inflation.
Mm-hmm.
theoretically, economically, you should be paid for additional risk you're taking by being in a diversified stock and bond portfolio. You should be getting, right now you're not, and it won't always be the case, but you should be getting something on top of that, even more return for taking additional risk. Right now, that's not happening, and that does happen in the market temporarily, but long term, your expected return for a stock and bond portfolio should be greater than what you get in a money market account. So with rates this high, we should be expecting higher returns from our investment accounts long term. So that is the math that should be going on here. We're not really seeing that right now. You're not being paid for taking risk in a diversified, or enough, not being paid enough for taking risk in a diversified portfolio. That will change. And I've seen it change before. So whether rates go down or the returns on investment portfolios go up, there's a lot of headwinds in the stock and bond markets right now. Higher interest rates have affected bonds. When you have higher rates, you have lower bond prices. It's how bonds work. I could get way into that as I do with my students, but I'm not going to do that here. I'll just describe the relationship. And for stocks, higher rates affect how they manage their business. They have to pay interest maybe instead of paying employees or development of new products, whatever else it is, and can create those headwinds. Companies are having additional headwinds by labor disputes, the war in the Ukraine, other things that are producing these pretty heavy headwinds for stock and bond markets. So we're watching that. Again, long term in the past, and that's the only thing we can go off of. These things have worked themselves out, and you end up, there's only a couple of days a year that you have these big upturns in the market. And if you miss those couple of days by not being invested, that's where the real losses can occur.
Yeah. And so that's the whole thing, I think, around timing the market is you really only need those 1 or 2 good days. And so you never know when those might be. So trying to time that properly. And so that was really highlighting that key there is that long term, and really sticking with it with these highs and lows. Because you typically are rewarded for that risk that you are taking.
Yeah, staying invested. I know to some people it's going to sound like a sales ploy that, well, you just want clients and you want them to stay with you and pay you your 1% or whatever else it is. And by the way, larger clients would get discounts to the 1%, but it's not just that. I do it myself. I stay invested. My accounts look like my clients' accounts. There's not really any difference.
Which I love that you're so transparent about that. As if you're going to invest your money with somebody, you want to know how their money's doing, if they're taking their own advice or if they're doing their own, following their own investment rules or following something else. Because then I know when the market is good, people want to jump back in. And then it's just more costly to do so. I was just reading this newsletter that I love to get. And they're like, jumping back in when it's high is like buying an Audi and saying, awesome, I just marked it up 30% for you. It's like, okay, I'll take 3. It's like,
yeah, and I mean,
the worst time to buy it.
When the markets are high, even your, cab driver, nothing against cab drivers, even your cab driver is saying like, oh, you should be in the market when the markets are moving up and moving up strongly. And that's sometimes the worst time to buy. I think right now actually might be one of the better times to buy. Even last January may have been one of the better times to buy. It's only that we can only see that in hindsight, but trying to time that is a fool's game. Stay invested. I don't think there's ever a bad time to invest, but just know that there's going to be ups and downs.
100%. And so, I want to touch on the idea that sometimes people think investing is really just gambling. I'm sure you've heard this before. I'm sure people come to you, just kind of saying that with their hesitancies. So how do you kind of go about, proving this false?
Well, I work with a lot of divorce clients, and that's often the comment because they think their husband was gambling their money away by putting it in the market. And so when we get to the end of the divorce and my clients receive some money either from the sale of a house or liquidation of investments or just there was cash there, they're reluctant to get invested and get started in the market. And we have to really educate them about what the market is, why strategic investing in a diversified way can get you a better return for the risk that you're taking, and that is needed for the long term. Oftentimes we'll do projections of what, if you are awarded these assets, what does it look like for your lifetime? How much do you need to work? Do you not need to work at all? But all those projections are going to be based on some assumption about investment returns, some average investment returns. So when that client is saying to me, I think it's like gambling, I said, well, it's not like gambling. We educate them on that. We'll get to the second part. Every time I've shown you these projections, we're putting some amount of return on those investments so that, you may not have to work while you're divorced, or you have to work less because these investments are working for you.
Yeah, definitely. And it's that main thing of if the cash is just sitting in your bank account, that one, the dollar that you used to have is going to start being really worth 50 cents.
Well,
And so,
there was a statistic about women wanting to stay in cash, and that's just signing on the dotted line to say, I want to lose money. I mean,
yeah,
why would you stay in cash? You've lost money to inflation every time. And I think people know that logically in that part of their brain, but emotionally, the fear of investing and seeing, a big dip in the market, for example, that we had in 2022 or that we had briefly in 2020, makes it feel more like gambling. We will have disruptions in the market. You will survive those in the long term. You'll be higher than where you are today.
yeah. I know that's why, like, one of the things is I don't look at the stocks every day.
And
I
you
mean,
probably, I don't look at
because
it every day.
yeah, because it's like, I
Most
don't
people.
need that minute view. I don't want to look at something so tiny, look at ants when it's like you have the whole world to look at. Um, and so, you can't have that narrow of a view all the time. So
And
maybe sometimes,
there are professional traders
right.
who are using things like momentum and other statistics to invest or get out of the market. There's the market often will signal to the Fed or signal to the government that whatever steps they're taking is not what they want it to do. And so they'll push the market down for a day or up for a day, depending on what the situation is. So all that is noise in the market, all the things you hear on CNBC, all the things you hear from daily pundits across the internet. Michael Burry talking about, we're going to short $1.6 billion. Like, I mean, I don't know the size of the market. I probably should get that statistic, but it's huge. It's certainly
Yeah.
more than 1.6 billion. And there's something like 60,000 bonds you can buy. There's something like 3,500 different equities you can buy. There are thousands of different kinds of annuities that are out there, and they have their own role for some advisors in their portfolios. It's really spending time with your advisor, understanding why they're doing what they're doing. And if something doesn't sound right to you, or if you don't understand it, talk to another advisor.
Yeah.
I want my clients to really understand. I don't like when clients come in here and say, I've been working with so and so. It might be a bank or someone else. And I asked them, can you just name one thing that's in your portfolio? And they can't. And I said, if that's the case, you need a new advisor.
Yeah,
I'm happy to
definitely.
take you on, whether it's me or not. You need another advisor. If you don't understand, even if you can't even tell me one thing that's in your portfolio.
And like I always tell people, you don't need to know every nuance. I mean, that is the point why they're paying you, but there is a point where it's you need to know a bit about what's happening. It's kind of like your car. I mean, you know a couple of things about the car. Now, do I know how to go in there and redo the engine? Absolutely not. I would hire somebody else to do it. But I do know that I need an oil change. I need to do the gas. I need to do these other things, and I'm still part of that conversation.
Exactly. And there's so many good advisors out there. Please don't be
Yeah.
afraid. You might run into a bad one. I'm sorry that has to happen sometimes, but there are so many great ones out there. You will find someone nearby who wants to work with you. And if not, call me. We'll
Yeah,
talk about
any at Purse Strings is gonna help you out and
right.
really be on your team. The last question I want to touch on here is how do you kind of help people with their investments during a divorce? I know you help a lot of people through a divorce.
Yeah, I have a story about that. I had a client, this was several years ago now, older client, and she's lovely person. We looked at her investment portfolio during the divorce, and she was likely to get half of an IRA, and in the IRA were some very risky holdings. And identified, explained to him why they were risky. I could get way down that rabbit hole, but they were very risky. So we went back to the attorney and said, is there anything we can do to preserve and protect what's in that IRA today, at the value that it is? Well, you can in an IRA sell everything and there's no tax costs being sold within the IRA. Talk to your
Mhm.
tax advisor about any tax advice. I need to be compliant here, but within the IRA when things are sold. So we sold to cash, and then moved to a more target date fund, which is a more diversified, highly diversified portfolio. And we were able to discuss that between the attorneys so that we would protect the assets that were in there. So he wasn't just, in that sense, kind of gambling with the IRA. So we'd make sure that she was protected during the pending of a divorce. Now, I'm not saying in every case you can get that done. Sometimes you have to wait until the divorce is over, get your share, and then take a less risky stance. But in our case, we were able to do it through temporary orders to insist that these assets this IRA be invested differently and in a less risky manner.
I love having you guys come on and just share these expertise, because I always learn something new. Like, didn't know that you could do this, or but it makes sense. Like
in divorce, you can split an IRA without withdrawing it, so there's no tax cost too. So in divorce, it's a division of an IRA incident to divorce. You have to wait till there's actually a decree. But people think that if they divide an IRA during divorce, that there's going to be a withdrawal and there's going to be a tax bill. That's not what happens.
Yeah, you got to get an expert like Pam on your team. So I appreciate you coming on and sharing these great stories and this great information on all this stuff. Is there anything that we didn't touch on that you wanted to make sure is shared today?
I do want to share really quick that I have a book called Financially Fit Divorce, and a YouTube video series, 30 Tips in 30 Days for Divorce, for any of you who have friends or are thinking about divorce yourself. At financiallyfitdivorce.com is the website. Financially Fit Divorce is the YouTube channel, where you can watch these videos. The book is called Financially Fit Divorce on Amazon, easy to find, Pam Friedman, or financiallyfitdivorce.com will direct you to those resources. There's also a course you can take, but no one likes to study for their divorce. They should, but most people will get the book. They won't take the course. That's fine. Just get the book. I think it's eye-opening to, and then for your nieces and your daughters, there's a book called I Now Pronounce You Financially Fit, talking about managing money in marriage and what can happen in divorce.
Yeah, you should definitely get these books. They're great. I know I have them on my bookshelf as well. And so if you have any other questions about today, please reach out to Pam. She's always happy to help. I know Pam always has like a free 20 to 30-minute call just to make sure it's a good fit for everybody. And let's jump in, get the conversation started. Pam and I were talking earlier. The worst thing is just some analysis paralysis and not taking action. So whatever it may be, either ordering the book, reaching out to Pam, just doing a bit more research. Let's start taking action today. So Pam's email has been going through the bottom, pam.friedman@rscapital.com. She's also one of our Purse Strings approved professionals, so you can check her out on our site, pursestrings.co, and her books are also on her webpage as well. So thank you again, Pam, for coming and sharing your expertise today. Yeah, and we'll talk to everyone again soon.
That's good.
All right. Bye.
Bye, everyone.